asset pricing model in portfolio construction. We'll be talking about the security characteristic line. We'll be talking about the security selection based on the security market line and the implications of CAPM for portfolio construction. Now, before I get into this, let me tell you that the security characteristic line is not important, right? It is not important. I don't want you to worry about this too much. The main focus is on the capital market line, which is obviously standard deviation oriented, and the security market line, which is beta oriented. This is the important one. So security characteristic line, not important. It is really weird. It is not based on standard deviation or based on beta. It is basically the difference in the return on the market minus the risk-free rate, which is basically the excess return the market has to offer versus the excess return the security is offering, right? Don't worry about this too much. It's not that important. Now this is important, which is your security market line, and then finding out, okay, which stock is overvalued and which stock is undervalued. So like I told you, this is a little counterintuitive. The one which is above is actually undervalued and the one which is below is actually overvalued. The reason for that is because for this level of risk, it should be giving us a higher return, but it is giving us a lower return. That's because it is overvalued. The price you're paying for this is too high. Therefore, the return you're making on it is too low. It should actually be higher. The reason why the return is low is because the price is overvalued, right? You're paying too much for this stock, whereas this one is undervalued, and that's why it is giving you a higher return even though the risk is much lower compared to what it should be giving you, right? So I mean, obviously you can use this for helping you with security selection. And why does the market sometimes price them differently? So when everybody knows that if the beta in this stock is 0.5, well, it should be giving a lower return, but it is still giving a pretty decent return. Whereas this one, the beta is more, but it is not giving as much of a return as it should be, right? As for the security market line, it should be giving this much, but it is only giving this much, right? So because markets are not efficient. So I mean, in the beginning we said the assumption, one of the assumptions is that the markets are efficient informationally, and that means that the market price should be equal to what the intrinsic value is. But the case is that that might not happen because investors might not have all the same information. And even if they do, they might not have the same assumptions or same expectations. So we've assumed that they have homogeneous expectations, but the reality is that they might not. And therefore, the stocks might be either overpriced or underpriced. You know, people are emotional. I mean, and you learn about this when you get to the equity section and when you talk about market efficiency, that there are behavioral biases. And even in portfolio management, you will learn about this, but in the second part of portfolio management. So basically, like I was telling you, you've done quants, you've done economics, now you're doing portfolio management, but this risk and return part 1 and risk and return part 2 is the only portfolio management readings that you have for now. Then there's corporate issuers, FSA, equity, right? Fixed income. Then you've got your derivatives, alternative investments, and then you come back to portfolio management. So you learn a lot more about these psychological issues, behavioral biases that are there. You learn a little bit about that in the equity in the market efficiency learning module. But yeah, markets are not 100% efficient, but they are efficient for the most part. So you might be able to find these mispricing, some overvalued, some undervalued stocks, and the SML can definitely help with that. So SML can help with security selection. Now, in terms of constructing a portfolio, obviously this is something we have discussed, that when you diversify, what happens is that you get rid of the non-systematic risk or the diversifiable risk, and then what you have left with is the systematic risk. That is it for the risk and return part 1 and part 2. Very interesting 2 learning modules. I hope you enjoy the rest of your material until you get to the other part of portfolio management. So, and I really hope that you're doing this in the proper sequence, because that is really, really important, because capital asset pricing model is used in equity and corporate issuers. So you must do it before studying equity. And I hope you are doing that. All right. Summary. So this is how the portfolio risk is calculated. This is obviously, you can do it on a weighted average basis as well, depending if you are having a risky asset and a risk-free asset, then how much you're putting in the risky asset will then define how much risk of the portfolio is going to be there, since there's only one risky asset in it. But if there's more than one risky assets, well, then you can use this formula. Right, we talked about indifference curves and how you can put them together with capital allocation lines. And then if you have homogeneous expectations, well, then that's where you get your capital market line coming in, which is basically going to be at that market portfolio. And then you can even put your indifference curve across this and then choose out a optimal portfolio. Now, the slope of that line is y2 minus y1, which is this top part, x2 minus x1, which is this bottom part, right? So it's minus 0, but we don't need to write that 0. So that gives you the slope, and this is your x variable. So whatever is the standard deviation of the portfolio multiplied with the slope plus the y-intercept, which is your risk-free rate, gives you the return you should get on a particular portfolio with a particular standard deviation. We talked about systematic and non-systematic risk. Obviously, this is all about macroeconomic risks, interest rate, inflation, natural disasters, political situation, business cycle, all of that, right? Non-systematic is idiosyncratic risk, diversifiable risk, can be diversified. It is idiosyncratic or local in nature, right? And it should be diversified. Now, single factor model, market model, which is your beta into the return of the market plus an alpha. How you could further expand it is through the CAPM. And in your CAPM, how do you calculate the beta? Well, that is your covariance of the stock and the market with the divided by the variance of the market. And of course, covariance can also be written as correlation into the two standard deviations, one of the stock and the other one of the market. But then the division, we also have the standard deviation of the market twice because it's variance, but one of these cancels out with the other. So what you have left is the correlation into the standard deviation of the stock divided by the standard deviation of the market. And then, of course, bring it all together with the capital asset pricing model with these assumptions. And it's very, very important because this is something you use in corporate issuers and equity to price and value the equity assets. Right. Then we talked about the security market line, which obviously is then purely based on systematic risk. So on the x-axis, it has systematic risk, and the slope is then this amount divided by 0 to 1, which is just 1. So you have 1 in the numerator, which is the same thing as not writing it. So then your slope just becomes the difference between these two. Whereas in the case of your capital market line, it was divided by the standard deviation. Here, beta is equal to 1, so it doesn't really make a difference. So that is your SML, can be used for identifying securities as well. Anything above the SML is undervalued and below is overvalued. And then we looked at these wonderful measures of performance evaluation, my favorite being Sharpe ratio, even though it's total risk based, and that is a limitation, and you need to know that as far as the exam is concerned. But in reality, that's the number one ratio that we look at when we want to evaluate the performance of a portfolio manager. But there is two limitations with that. Number one, it is total risk based. Number two, it doesn't say anything, right? Okay, so somebody has a Sharpe ratio of, let's say, 15. What does that mean? You have to compare it to something, right? And that's where your M squared comes in, that you say, okay, so this is the excess return I generated. Let me divide that by the risk that I have taken in that portfolio. So now I will get it in terms of per unit of risk, what's the extra return I generated. And then let me multiply it with the risk of the market, which will tell me, okay, how much return extra I would have generated over and above the risk-free return if I took the same amount of risk as the market, right? And the market would have given me this much extra compared to the risk-free rate, and I've actually, for the same amount of risk, generated more than that. So when I take my extra divided by my standard deviation and then multiply it with the market risk, I basically calculate what would be that amount which I would have generated if I took the same risk as the market. And if it is more than what the market would have generated, then that means I have done better than the market. So that is pretty good. At least it gives us a comparison, a benchmark. But the problem is that it's still total risk based. It's still using standard deviation, right? So if you want to deal with performance evaluation of portfolio managers who have diversified their portfolios, well, then you have to get into the world of Trenner and Jensen. And Trenner is basically just like your Sharpe ratio. The only difference is instead of total risk, we're taking beta. And of course, Jensen is basically whatever your return is minus what was expected from you. And what is expected from you is actually calculated through your capital asset pricing model.